what if prices can't go high enough so that peakers can earn those scarcity rents? If for some reason we feel like we can't allow prices to go as high as they need to justify building that peaker unit, then it's not going to be built. If we limit the price from going up as high as it needs to draw peaker units into production long enough during the year to make a profit, then either the peaker won't be built or other baseload resources might not be built. So if the peaker's not built, then the supply is there's going to be a steeper merit order supply stack. So suppose that we can't allow the price to go up high enough to justify the peaker, then the entire supply stack gets shorter, and we can expect to get to periods where we have this limit on price, and if the price can't go any higher, there are resources we wouldn't draw into the supply stack. So a limit on price is not only going to prevent some resources from being built, but it's also going to limit the scarcity rents that other resources are earning in the market. So if there are periods when the price is held below the marginal cost of bringing new resources into supply, first of all, those resources won't be there to provide the supply. But second, we're limiting the amount of scarcity rents earned by our other resources and lowering the rate of return on all those other resources and reducing the incentive that entrepreneurs have to bring their capital into this sector and add to the supply. So one of the things that could happen if you weren't providing the necessary incentive to add peaker units is that we might overbuild baseload capacity, or we might end up using demand reduction too often. We might use load shedding more often than we need to. So let's take a look at our supply stack and see what it would mean if we didn't build the peaker. So let's suppose that for whatever reason we felt like we needed to put a limit on the price. We're going to have our limit on price as this green bar across the top. And we'll talk about why we might feel like we need to limit price. But first we want to think about the consequences of this in terms of the incentives we're providing for generators and for entrepreneurs. Suppose we place a limit on price. So the price can't go any higher than, well, let me go back to my pencil so it can be a little more specific. The price can't go any higher than this. Well, first of all, if that's true, then that is going to limit the amount of time that the peaker can earn scarcity rents. Right? There would have been times when we'd be up here, and up here we'd have prices higher than this limit. Those prices are essential for some peaker to have been built because the last peaker built is not going to be running that often. If we limit the amount of time that these last peakers can earn scarcity rents, then entrepreneurs would be less interested in building those plants. So let's suppose that we have this limit on price. I'm going to get rid of these two plants. We have this limit on price. Then what about this last peaker unit? It might not be worth building anymore. What happens if we don't build the last peaker unit? What happens to the supply stack? Well, it shrinks by the peaker unit. So our new supply stack actually will be here. And so if we had this demand, if we had this summer demand that would have given us a higher price, I'm sorry, that's the wrong demand. Let me erase that and draw my limit back. Here, let's get our price limit back and come back to my pencil. So if we would have had a high demand period that would have caused a higher price, so we would have had a price up here above the price limit. Here's our limit. Price limit. If we have a really hot summer day when we would have gone all the way up to a price of, say, 75, but we're not doing that because we're limited to a price down here, maybe that's 65, then the peaker is not making the extra $10 on each megawatt hour generated. And in the end, that might be enough so the peaker won't be built. If the peaker is not built, then our supply stack falls back by the amount that this peaker would have generated. And our new supply stack would lead us to reduce the amount of load for which we match with generation resources. So it means we'd have to reduce the quantity of electricity supplied, and certainly if we didn't have the peaker unit on this hot summer day and the price is limited, then the only option available is not to supply the available demand, and either that means load shedding, or if we had demand reduction contracts out there, we would be using those demand reduction contracts at a much higher price than if the peaker had been built in anticipation of the increased scarcity rents. So by pulling the peaker unit out of the supply stack, we are essentially, we're doing two things. We're reducing the scarcity rents that sources get, that all of our sources get, and so all across the range of resources we're reducing the incentives to build different assets, and there are going to be times when we're unable to meet the available demand because we're not able to bring to bear resources, enough resources to meet this high demand period, because the only available resources would have had a higher marginal cost than the price limit. They won't run because we have a price limit below their marginal cost, and of course they would never be built. An entrepreneur would never build a power plant if they were never going to be able to charge the marginal cost of running the power plant. But we're reducing scarcity rents for everybody, so these are lost scarcity rents from not allowing the price to go up as high as it needs to draw in those marginal generators. And that reduces the incentive to build all of our different elements of our capital stock. But in particular, our peaker might not be built, and that results in the need to shed load or to get some expensive demand response.